Krishna Kumar joins us, represents Sundaram Eco Mutual Funds. KK, good morning. Thank you for joining us. How are you feeling about the market now? Do you think we are in for a temporary, relief? Last 5-6 days, yes, we've seen some green on the screen, but that's not permanent.
I think there's been a lot of pessimism that's been around for the last 1 year, and the data has not been supportive. There has been global noises on trade wars, etc. Plus the domestic slowdown is not helping. But at some point, I think the valuations are getting a lot more interesting. The prices are more interesting now, and the kind of negative growth you're seeing in sectors seem to be indicating that you probably are hitting a bottom in terms of how much lower you can get to. And some of the actions taken by the government show some intent to stem the tide, and the government's expenditure program is kind of accelerating. So we're getting into a phase where, the second half would be far better. The government spend, the liquidity coming through system will increase, helping the economy to bounce back. The monsoons have been good, and that will have an effect into the third, fourth quarter. And of course, the second half base effect kicks in also. So all these things do point to some kind of thaw in market correction. We should see that data incrementally gets a little bit more positive over the next couple of months from what you have seen in the last 1 year. So that's a belief that we have, and second quarter definitely has been a bit of a slow quarter than the first, and that should be probably the bottom in terms of growth in our opinion.
Okay, why are you confident that growth will come back? We got the same sense of optimism from everyone a year ago that 2019 will be a breakout year for earnings. Look at what do we have. Earnings are poorer than 2018. Now we can blame it on slowdown, we can blame it on crude, we can blame it on trade war. There's always a reason why markets go up and down. But what I'm trying to understand is that how can you be certain that tomorrow will be better than today?
Definitely, some of the things that we are talking about is based on historic trends, basically, that you have seen when you had slowdowns and the kind of points of reversal in terms of earnings downgrade cycles that you have seen. It's also about the valuation points at which markets do bottom out. It's also corroborating with the kind of attractiveness of equity from looking at things like earnings yield gap, comparing the earnings yield of Nifty mid caps vis-a-vis the government securities, etc. So some of these long-term indicators are showing leading us to a belief that the markets could be bottoming out here. The more important thing is that while we are looking at a 5-6% kind of growth into this year, globally, I think the situation is a lot more conducive. You have seen that the ECB has got into the next round of QE. Fed probably will be cutting rates going forward in the next week. With also the inflation where it is, the monetary stimulus from the RBI could continue to be positive and help improve the demand situation. And you also have the government getting into this positive action mode after the elections and the budget. So I think a lot of these things do give some pointers to an improved showing into the next 6 months. And if you look at also the market, the secondary market in terms of goods and inventory in the supply chain, I think clearly there is an effort across to get the sales moving from the retailers, and the OEMs are basically stepping back on production. So you are seeing a lot of normalization of inventory in the supply chain, and this basically would lead to a situation 2-3 months down the line when the primary production and sales start to get much better than where we are. So this is typically the cycle of destocking that you also see, which will lead to a primary sales getting better over the next 6 months.
KK, though, from a retail investor standpoint, you've got the Nifty Midcap Index, which is lifted about almost 3.5% from the August 2019 lows. And that can be said about the small caps as well. A sharper recovery there, roughly about 6.5%, though still a long way to make up for their all-time highs. But then again, would you say that would make sense to tactically shift your portfolio, skew it a little bit, have a larger exposure now to mid and small caps because that's where value as well as valuations are favorable? Or would you say continue to be large cap restricted because they're safer?
See, I think I just want to make a point here before we answer this question. If you look at the current year, even though the BSE 500 is a little negative, there are about 1/3 of the stocks which probably are positive returns in this year, and about 100 stocks of them are given 10% plus kind of return. Similarly, if you look at the NSE Midcap Index, about 25% of the stocks are again in positive plus 10% kind of return territory. So there are definitely those stocks which have bottomed out earlier, which are probably doing better. So I think more importantly, we need to get into being in equities and continue to be invested, and whether it is large cap, multi cap, or mid cap, I think it's all about individual risk appetite. But I think the most important message is that we need to be there and continue to be invested at this point in time. And if you were to look at kind of a comfort in terms of between mid caps and large caps, of course, given the huge amount of correction that we are seeing in the mid and small cap space and the valuations at which they are trading at this point in time, definitely there's a stronger case to allocate more towards mid and small caps. But again, considering the investors' risk appetite and the fact that they've been through a negative return phase for the last 2 to 3 years, I think it would be prudent for them to come into something like a multi-cap product and then slowly increase their risk appetite depending upon how comfortable they feel about the markets and the recovery.
Okay, fair enough. So are you betting on the domestic story then on the back of the recovery? Would you be looking again at banks, consumption? Where would you be seeing the opportunity currently?
I think over the year, when you've been talking, you would have noticed that we continue to have been maintaining a bias towards the domestic story, a lot more to do with the domestic consumer discretionary space across things like the durable sector, the consumer durables, the retailing, the apparels, the women's apparels, the jewelry sector, etc. We've been quite positive on also the consumer financials, particularly the private sector ones, which have been continuously, been able to deliver growth. So these continue to be the areas of interest to us, and we would continue to be focused there. And to play the recovery from a cyclical perspective, we also have been increasing our exposures to the industrial space, be it the light engineering, the early cycle capital goods, the cement space. Companies which have good capacities to grow and also having a reasonably good balance sheets and with good credible promoters like MNCs, etc., we've been backing them in the portfolio. So it's been a kind of approach of both playing the consumption on a discretionary basis and the domestic cyclicals from the industrials and cement, which have been doing better, and we believe the next 3 years they would be offering a lot of alpha to the portfolio.
Okay, fair point. On the point that you were making, KK, and interestingly about the broader markets, the small and mid caps, where you said that, most of them are still sitting at an all-time high. And I'm just looking at the list of the recovery that some of them have made from their August lows, everything from a Bombay Burma to a Dilip Buildcon, to an HEG, Jubilant Life, Sterlite Technologies, Oberoi Realty. It's a very large list of gainers there. We were just talking about as to how some of the footwear companies, Bata, Relaxo, even a Khadim, they're all holding out very well. Paint companies have delivered excellent earnings as well in the quarter gone by. Within concentrated pockets, where is the opportunity within broader markets?
I think, across broader markets, you need to look at all the small sub-segments across different larger categories. For example, if you look at materials, probably we talked about cement doing good, but then you have a host of specialty chemicals companies which are enjoying a lot of growth, and particularly growth driven by outsourcing from global MNCs, etc., which we are seeing and which are playing also. Similarly, if you look at other areas like healthcare, pharma, well, pharma may be a little bit of going through a problem on the generics front, but there are a lot of domestic pharma which have done well, and also particularly the healthcare, the hospitals and the diagnostics basically have been a growth engine which have been firing well. So you have seen a lot of outperformance coming there, and we think that could be sustainable. Similarly, if you look at the consumer sector, one would be worried about the slow growth in the FMCG space, but there are those companies in the beverages and the liquor which have been growing at double digit and more and have been standing out in terms of performance. Also, across discretionary, be it the kitchen appliances or the white goods, I think there have been pockets of growth which are standing out in spite of the general weakness across consumer and particularly auto space. So there are some of these areas which we think are good to go with. Also, again, on the retailing side, while men's apparels have been going through a lot of pain, the women's apparel companies have been doing well, and fast fashion is something that has been extremely buoyant over the last 2 to 3 years, and stocks there again have been doing well. So I think.
Krishna, I'm going to come back to you and just allow you to finish that point as well. Do bear with us. We also have an ET Now exclusive that we need to go to. Bharti Airtel is in fundraise mode again, and it will be for investing in the business and, of course, fighting out rival Reliance Jio, which has, remember, monetized its optic fiber assets via an InvIT. Nayantara Rai has that exclusive report for us. Nayantara.
Thanks a lot for that. So we at ET Now are exclusively picking up that Bharti Airtel is planning yet another fundraise after the Apple and that massive rights issue. This time round, it's going to be an InvIT of more than $2 billion to monetize its pan-India optic fiber. Now, Bharti Airtel was initially planning to do this in a joint venture with Vodafone Idea. The talks have been on at the levels of the principal promoters, Sunil Mittal and Kumar Mangalam Birla. But we have been told by sources it just didn't fructify because very soon after that we started seeing Vodafone Idea go through financial stress, if I could call it that, and therefore Vodafone Idea's fund requirements are far more urgent and far more different than Bharti Airtel. Bharti Airtel is planning the InvIT on its own. What's interesting to note, and something the markets will want to watch out for, this fundraise will not be to deleverage. Bharti Airtel's debt position manageable at the moment. Remember, it has been going through a lot of fundraise exercises, like I was just pointing out. This is a pure play, perhaps capex expansion, invest in the business, stay relevant, take on the mighty Rel Jio, and that's why it is standing. This InvIT feelers have been sent to investment bankers as well, should be appointed soon. Of course, I reached out to Bharti Airtel with a detailed query. The company has not responded.
All right, Nayantara, thanks a lot for that. KK, is there merit in buying Telecom? I mean, first it was 12, then it was 5, now it's only 3 within that third player, which is Vodafone and Idea. They're struggling. Stock markets don't like that stock. You're only left with Bharti and Jio. Does it make sense to bet on Telecom?
I think over the last 1 year, there has been a very sharp improvement in terms of what the prospects hold out for. With the consolidation in the sector that's been triggered by Jio, and also the fact that the entry barriers have become pretty high at this point in time, I think a long-term investor would make a lot of money in telecom and data over the next many years. So it's definitely a contra bet at this point in time to get into and wait it out patiently. Some of our funds do have higher exposure to telecom than from 1 year back to now. We definitely are much higher on telecom at this point in time on the large cap side. Yeah.
Okay. You were going through some of your sectoral views, KK, so I'm just going to allow you to finish that and also touch upon industrials like early cycle cap goods, cement, because I think you might be looking at that area positively as well?
Sure. So what I was trying to highlight is that across segments, larger sectors, there are smaller pockets which are doing well, and I think the entire approach to investing has been to identify these smaller sectors, which would add value to the portfolio. So moving on the industrials and the capital goods side, I think there are those industrial consumables which are doing pretty well. Having a good double-digit growth, even though the markets have been overall ignoring them. Also, the fact that if you look at some of these, machinery which go into road capex and also into some of the early cycle replacement capex, etc., there are those products which are very niche and which again represent presence of global MNCs in these areas. So I think that's where I think we would like to buy into the products basically on the industrial products and industrial consumables as a space to be into. Cement, I think, is another area which has been playing out well. I think there is enough long-term growth in this country for the cement to play out. Plus, I think more importantly, the cost template is getting a lot better for these companies, and that would be a significant, a hedge against any price correction that they would encounter. So that's one of the big bets that we have as funders from a medium-term perspective.
Sure. KK, great to have you on the show. Thank you so much for taking the time out and speaking with us as always.